Welcome to your deep dive. Today we're digging into nCino's Q2 fiscal 2026 earnings call. And this one definitely made some waves in the market.
It certainly did. We've looked through the call transcript, the numbers, analyst takes, and we're going to unpack how this company focused on AI for financial services delivered results that really sparked a reaction.
Right, because the market clearly liked what it heard. Let's start with the results themselves.
Yeah, the headline is they had a genuinely strong Q2, beat consensus estimates pretty much across the board.
Okay, so let's put some numbers on that. Non-GAAP EPS, that's earnings per share, came in at $1.22, which was, what, about 8 cents higher than the street expected? Around $1.14 was the consensus, I think.
Exactly, and there's over an 8-cent beat. That's not small potatoes. It suggests, better efficiency or maybe revenue dropping nicely to the bottom line.
And speaking of revenue, that was also strong, $148.8 million.
Yeah. Beat by about $5.6 million over the consensus of roughly $143.2 million. That's solid growth, too, 12% year over year.
And for a company like nCino, that subscription revenue is crucial. How did that look?
Very healthy. Subscription revenue grew 15% year over year, hitting $130.8 million. That shows customers are sticking around, maybe buying more. It's the core engine, like you said.
What stood out to me, though, was the operating income figure.
Ah, yes. Non-GAAP operating income hit $30 million. That's roughly 20% margin.
And the growth there was huge, right? 56% year over year.
Huge. That points to real operational leverage. They're getting more profitable as they grow. And when you combine that kind of performance with a raised outlook, which we'll get to, you can see why the market got enthusiastic.
Definitely. So, okay, strong numbers. Let's pivot to the strategy behind them. What did management emphasize on the call?
Well, there were three main pillars that kept coming up. First, they're seeing demand strengthen in their key markets. Second, big momentum with their AI banking platform. And third, this ongoing shift to a new way of pricing platform and asset-based pricing.
Right, they're really leaning into that leader in AI banking message, using their cloud platform as the foundation.
Exactly. And that AI piece isn't just talk. The first pillar of their AI strategy is something called Banking Advisor.
Okay, tell us about that.
So this is an AI interface built specifically for banks. It's not some general AI tool. It's integrated right into their workflows, understands financial products, processes, even regulations.
That sounds like a key differentiator, knowing the specific domain.
Precisely. That domain knowledge is the moat. And it's getting traction. Over 80 customers have bought it already.
And it's evolving. They mentioned something about agentic workflows.
Yeah, that's the next step, making it the main interface for more sophisticated AI, things that can potentially manage complex tasks more autonomously. They're planning rollouts starting next quarter, so that's definitely one to watch.
Why is this AI focus working so well for them now?
Management basically said AI is a constant topic in sales conversations. It helps them close deals, and it also helps convince existing customers to move to that new platform pricing model we mentioned.
Because the AI features are embedded in the platform offering.
Exactly. The CEO made a point that banks want partners who get banking, can drive change, and have the data foundation for real AI. nCino feels they tick those boxes because of their history in the sector.
Makes sense. And what about their recent acquisitions, Circle and Sandbox Banking?
They said those are on track, both financially and technically. The integration is setting them up for sales later this year, especially for things like customer lifecycle management, CLM, and better system integration. It's all about building out that comprehensive platform.
Okay, so the AI is driving deals and pulling people towards this new platform model. Let's talk more about that pricing transition.
Right. This is a big multi-year shift for them, moving away from selling individual tools.
Towards selling access to the whole AI-enabled platform with new pricing.
Correct. And they're making progress. About 21% of their annual contract value, their ACV, is already on this new model.
21%. Okay. And what's the payoff they expect?
They're guiding for roughly a 10% uplift when customers renew onto this platform model. The idea is customers consolidate tools, get the AI benefits, and see value worth paying more for.
And there's a key timing element here, right?
Absolutely critical. The biggest group of customers due for renewal under this new pricing hits in Q4 of this fiscal year, FY26. So that quarter will be a major proof point. Does the strategy work? Do they get that 10% uplift at scale?
So it's less about counting seats and more about aligning price with the value and efficiency gains the platform delivers. Sounds better for big banks, too.
That seems to be the thinking. And interestingly, about a third of that 21% ACV already converted comes from the mortgage side.
Even in a tougher mortgage market, That's telling.
It suggests the value proposition is resonating.
Okay, let's talk about where they're seeing this traction. Customer wins. Any highlights in Q2?
Definitely. In North America, they landed expansion deals with 2 top 50 U.S. banks and a top 5 Canadian bank for commercial lending. Big enterprise wins.
Nice validation. And internationally.
Good progress there, too. They signed their first customer in Spain. Big potential market. They estimate over $4 billion in continental Europe.
Wow.
And their partner, Infosys, took ABN AMRO live in the Netherlands, replacing multiple old systems with nCino. That shows capability in complex, large-scale replacements.
Plus, they mentioned a UK challenger bank significantly increasing their spend.
Yeah, boosted their ACV by over 80% by adding onboarding solutions. Classic land and expand success.
What about smaller institutions? They mentioned focusing on credit unions this year.
That focus seems to be working. 6 new credit union logos in Q2 plus 35 cross-sells, including one deal with a $12 billion credit union that went over 7 figures annually across several solutions. So it scales down effectively, too.
And even mortgage, you said. Seen some life there.
Signs of recovery, yeah. Expansion deals with over 50 mortgage customers. And U.S. mortgage subscription revenues were actually up 22% year over year, mostly driven by big independent mortgage banks and home builders finding efficiencies, it seems.
Okay, so broad-based strength. Let's look at the guidance then. What are they projecting for Q3?
For Q3, revenue expected between $146 and $148 million. Subscription revenue, $127.5 to $129.5 million. Non-GAAP EPS, $0.21 to $0.21, and operating income, $31.5 to $33.5 million.
They mentioned a slight sequential dip in Q3 revenue.
Yeah, but they flagged it as normal seasonality. Nothing to be alarmed about, apparently.
The bigger news was the full-year guidance raise.
Absolutely. They bumped up the full fiscal year 2026 outlook pretty significantly. Revenue now seen at $585 to $589 million, up from the previous range.
Okay.
Non-GAAP EPS raised to 77 cents to 80 cents. ACV expected between $564 and $567 million.
And that mortgage outlook change was quite something.
Huge shift. They now expect U.S. mortgage subscription revenue to grow around 5% year over year. They were previously guiding to flat. That's a big positive revision.
What about that Rule of 40 metric?
Yeah. Still committed. They reiterated confidence in hitting the Rule of 40, where revenue growth plus profit margin equals 40% or more around Q4 of fiscal 27. It shows they're balancing that growth push with profitability discipline. And capital allocation, still buying back shares. Yep, bought back about 750,000 shares for $20 million in Q2. Focus remains on getting value from past acquisitions and share repurchases. Oh, and on professional services, the focus is shifting more towards profit growth than just revenue growth, trying to speed up deployments using AI and sandbox tech.
Makes sense. Okay, so strong quarter, raised guidance, clear strategy. How did the market digest all this?
Very positively. As we said, shares jumped over 10% after the report and held those gains. Clear sign investors like the beat, the raise, and especially those tailwinds from AI and the new pricing model taking shape.
And analysts followed suit. Price target increases.
Yep, multiple PT raises. JP Morgan noted nCino seems to be doing better than others in a tricky spending environment for banks.
Even Piper Sandler, while keeping a neutral rating, acknowledged the AI deal wins.
Right, so it feels like the narrative around nCino is shifting.
How so?
It's moving away from just being a recovery story towards something more like durable, AI-driven platform growth.
Yeah.
That implies a more sustainable, positive, long-term view.
Interesting shift. So looking ahead, what are the key things for us, for you, the listener, to watch?
Well, obviously Q3 results to see if the momentum continues, but the big one is Q4 FY26, watching those renewals under the new pricing. Do they hit that 10% uplift target? That's crucial.
Also tracking the rollout of more AI features and watching for more big bank wins, especially in Europe.
Exactly. And while bank IT budgets are still somewhat tight overall, the fact that digital lending and AI are often prioritized really plays into nCino's hands.
Any specific risks they mentioned?
There was some chatter about stablecoins impacting community banks, but management downplayed it, saying it's not a high priority for their customers right now.
Okay, so that brings us to our favorite segment, the Not Financial Advice Corner.
Absolutely. Just a reminder, this is purely for entertainment, maybe sparking some ideas, definitely not investment advice. Do your own homework.
Always. So based on this nCino call, what's an outrageous but plausible trade idea?
Okay, idea 1. The AI tidal wave, long strangle on nCino itself.
Long strangle.
Yeah.
Betting on big volatility. Explain the thesis.
The thesis is nCino just delivered strong results, raised guidance, the AI story is hot, the market rewarded them. But Miti, that huge Q4 renewal cohort is coming up. It feels like it could be a make-or-break moment for validating the whole platform pricing strategy at scale.
So it could go really well or not so well.
Precisely. Binary-ish. So the action would be maybe buying out of the money calls, say, 25% above the current price, and simultaneously buying out of the money puts maybe 25% below. You'd want them expiring a few months after those Q4 FY26 earnings are released.
So you profit if the stock makes a massive move up or down around that earnings release and renewal news.
That's the idea. If they smash the renewals and prove the uplift, the stock could soar. If they stumble on AI integration adoption or hitting that 10% uplift target, the market might hammer it. You're betting on a big swing either way. High stakes.
Okay, interesting volatility play. What's idea 2?
Idea 2, the Spanish Inquisition credit spread on a European legacy competitor.
Okay, targeting the competition. What's the logic?
nCino just landed in Spain. They're talking up a $4 billion European opportunity. AB and AMRO went live. They're clearly targeting Europe. Their cloud-native, AI-focused platform looks like a threat to older, traditional bank IT providers there.
So the action.
Identify a specific European legacy bank IT vendor, one that looks vulnerable in lending or onboarding tech. Then consider selling an out-of-the-money put option on that company.
Selling a put. So you collect premium, betting the competitor's stock won't fall below a certain level, or at least won't collapse completely.
Kind of. It's more like a bet against the competitor. You're betting that nCino's growing presence will put pressure on these legacy players, maybe causing their stock to stagnate or decline modestly, but not necessarily crash below your put strike price. You collect the premium as nCino potentially eats their lunch over time.
Okay. So you profit from the belief that the legacy player is under pressure and less likely to rally significantly.
Yeah.
The risk is they adapt or nCino's expansion stalls.
Exactly. It's a bet that the competitive pressure from nCino will cap the upside or even lead to downside for these older European incumbents. If nCino really becomes the AI banking leader globally, these guys will feel it.
Gotcha. Two very different thought-provoking ideas there. So let's just quickly recap our deep dive on nCino's quarter.
Yeah, fundamentally a very strong performance. Beat expectations, raised guidance, and showed real progress on their key strategies, AI and the new platform pricing model.
And the market reaction really underscored that shift in narrative we talked about, moving beyond just recovery.
To durable, AI-driven platform growth. Seems like investors are buying into the long-term story now.
Absolutely. We've covered the numbers, the strategy, the market reaction, even those speculative trade ideas. But maybe the final thought for you, our listener, is this. What does nCino's momentum signal about the broader transformation happening in banking? Is this AI-driven platform approach the inevitable future, or are the hurdles bigger than they appear? Something to chew on. And remember, everything discussed here is for informational purposes. Please do conduct your own thorough research before making any investment decisions. Thanks for joining us on this deep dive. We appreciate you listening. Join us next time as we unpack another key earnings call.